Hey, all right.
All right, and with that, we will call the meeting to order. Ann, do you want to do a roll call?
Sure. Member Ford?
Here.
Member Berry?
Here.
Member Tiedemann?
Here.
And I'm here, and Chair Rowden.
Here. And would anyone like to read the land acknowledgement? I will do it then. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lejeune. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home. So the next item is the consent calendar. Does anyone have any questions, or would anyone like to move consent?
I'll move consent.
I'll second.
Perfect.
Member Ford? Yes or no for the approval of the
Yes.
consent? Member Berry?
Yes.
Member Tiedemann?
Yes.
Vote yes, and Chair Rowden.
Yes.
And it passes.
Next item is public comment. There is no one here. Is there anyone?
No.
All right. Does anyone have any announcements? All right. I'm now moving on to reports.
First time I've done this here, so I'm a little nervous. So this is our quarterly review of the pension fund that CIBC has been monitored and managed. And should I click on this button to move forward, or?
No, just
Oh.
tell me.
Okay, let's move forward. So basically, I'm just going to go over the portfolio review, current asset allocation of the portfolio, the market change in value for the last quarter and since inception, and investment performance. And then after that, I'll go over our firm view for market outlook for the second half of the year, so next quarter and the second half of the year. In terms of asset allocation, this is where things were at the end of the second quarter. In the portfolio, there's about $85,000, which translates to about 3% in cash. Bonds is about 1.125 million, 1.124, or 45%. And stocks about $1.26 million, so a little over 50%. So current asset allocation, at the end of the quarter, the balance of the portfolio was $2.474 million. Now, just to remind everyone, this portfolio we invested in with the target of very balanced, more conservative to balanced. So about 50% bonds, 50% stocks. With the cash and bonds, we're right there. Can we go to the next page? So change in market value for the second quarter. So we started out the quarter at $2.7 million. We transferred $300,000 to the bank account for the pension. Income, which is dividend and interest and dividend received from the investment, about a little over $15,000. And capital appreciation was the price change, the gains in the funds that we invested, $48,000. So total return for the last quarter is the income and capital appreciation, so close to $64,000, giving the ending balance of $2.474 million. This is a summary of cash flow since inception. So we started managing the accounts September 2009, close to $11 million. Over the years, close to $15 million been taken out. And income received about $2.3 million, and the gains from the investment was a little over $4 million, giving the ending balance at the end of June $2.474 million. Here's the investment result so far this year. So for the first half of the year, the portfolio returned 4.57%. Average the last 3 years, 7.83%, and then since inception, so since September of 2009, about 6.7%. Reminding everyone again, this is a balanced portfolio, about 50% bonds, 50% equity. Previously, at some point, we had a little more equity and a little less bonds. It was depending on the market condition. A few years ago, interest rate was a lot lower, so we were more overweight on equity. That kind of contributed to a better performance returns in 2009 if you just stuck with the average 50-50 bond and equity. So over the last 3 years, still 7.8% return with a balanced portfolio is an admirable return for a balanced portfolio. Look at year to date, I'm sorry. On the bond side this year, bond gave about 2.3% return, and then stock is about 7.14%. Now this is if you look at the stock, 7.14 compare against the value index of up about 5%, but the S&P was up close to 17%. The S&P was more growth oriented and more volatile if we look at the performance of last year for the entire year last year, the S&P was down about 19%. The stock, the Dodge & Cox stock fund that we invested in for the pension was down in the low single digit comparing to the S&P down close to 20%. So on the way up, this makes sense when you compare this against the value index instead of the S&P, because we focus more on the stability of the equity and focus more on the income generated from the fund. So the last 3 years number shows the outperformance of the strategy in Dodge & Cox fund, 18% versus, if you look at just the value index, a 14% average, and the S&P also averaged 14.6%. So basically in 2020, we had a big sell-off, March and April of 2020, market rally, and a big rally in 21, a big drop in 22. Throughout the 3 years period, Dodge & Cox fund have average return over 18%. In a very growth-oriented market cycle and a value-oriented market cycle as well in those 2 years. So that contributed to about 12% in return for on the stock side. And when you average out over the life or since inception, that's contributed to a significant outperformance there. This is a summary of what we own, of course. There, on the bond side, there are two funds, the Vanguard Short-Term and the Dodge & Cox Income Fund. The reason for the short-term bonds, so last year, we had a longer kind of duration bonds in the portfolio. When interest rates started to go up, our firm reduced the duration of the portfolio and bought more short-term bonds, and that contributed to the Vanguard short-term here. Okay. And next is our, can you move to the next page? Our market outlook for the third quarter. So this is a summary of what happened in the first half of the year. I went over a little bit. U.S. stock, which is the S&P, up 17%. International stock and emerging market, international developed market was up close to 12%. Emerging market, which is China, India, and other countries, up close to 5%. We don't have any international in the pension portfolio. And again, the stock in the portfolio was focused more on value, so wasn't representative of the S&P. Just wanted to give you a sense of where things were. If you look at the bond side, so far this year, long-term Treasury returned about 3.7%. At the end of last year, long-term Treasury interest rate was at the high, and Treasury rates on the long end went down a little bit this year and contributed to the better return on long-term Treasury. The bond side of the portfolio is more compared to the intermediate, which is 8 years or less in the bond. So up about 1.5%. If you just look at government bonds and corporate bonds, remember the bond side of Dodge & Cox Fund did very well, up 2.5%. Also, the shorter term bonds that we have with Vanguard contributed to a little bit better in performance. On the commodities, this shows very well what we talked about a few quarters ago about inflation. Remember, this same time last year, commodity index was up double digits. Oil was up significantly. Gold was relatively flat, but that was at the time last year when we had inflation closer to 9%. Right now, if you look at the commodity index down, comparing to the same period of last year, about 8%. Oil went down about 8.5%. That's what we've been talking about, or since last quarter, the inflation easing for this year. So this is our investment theme going into the third quarter. Just looking back at the first half of the year, the U.S. economy performed very admirably. It was more of a, we ended the year right now, it could have been an excellent year for the market, up double digit. And the economy going into this year, a lot of strategists and economists, including ours, expected the economy to struggle for growth, and we actually expected, going into this year, we expected some kind of a recession toward the end of the year. Right now, with the data that we have seen the last quarter and the leading indicators for the next few months, it's highly unlikely that U.S. economy would head into a recession this year. Although leading economic indicators is still showing that the recession is ahead. Leading indicators have been, we had a bear market last year. We have a significant slowdown in consumer spending. Corporate earnings have been on the way down. Why does that show in terms of stock return that the market is so strong? Well, corporate earnings have been on the way down, but everyone or most analysts and strategists projected that earnings would come down much more. So earnings has been down, but it's less than fear. And that contributed to a more positive sentiment on the market. So investors were prepared for the worst, and the number has been quite mild. We were worried last quarter with the regional banks issue. Silicon Valley Bank went down and First Republic went down. That would contribute to a significant slowdown in the economy because regional banks are the engine that providing lending for small and medium-sized businesses. When regional banks are in trouble, a lot of other banks in the same space would have to cut back on lending, and they did. They cut back in lending. It's very tough and with higher interest rate, it's tougher for small and medium-sized business to get business loans. But the positive thing is there are still quite a bit of cash in the overall market. So on the private side, private funds, private equity, those are the fund that came in place of regional bank and provided alternative lending for small and medium-sized business. rates are higher, but for the rate of growth for many companies, they were willing to pay for the higher rates. So it seems like the struggle in regional bank hasn't translated into a significant slowdown in the overall economy. Bond yields went up over the last quarter. It went down at the end of last quarter because of the concern with regional bank. When things stabilized, bonds became more attractive again. But it's also part of the concern that inflation would start picking up. Because if you look back at what the Fed talked about last quarter or 6 weeks ago, it was a concern about the health of the labor market. The labor market is fully employed, so unemployment is very low. And that basically for anyone, of course there are pockets of the economy where employees struggle to find jobs. It's just a natural course of a business cycle that there are pockets that struggle, but overall economy employment is very, very healthy. And so with the strong labor market, average income per laborer has gone up. And that's translate into what the Fed's been worried about, that inflation is more sticky than they thought. Prices on everything else, like I talked about, housing actually stabilized. On the commodities and kind of other part of the inflation calculation has come down. Energy has come down a lot, but labor is still the sticky part, and that worries the Fed. And the language is we have to maintain our stability with labor for, there's an equilibrium that the Fed is looking at where the health of people who look for work and the new supply of new jobs is on a equilibrium, not, companies right now are struggling to find help when, a job open, it's hard to fill that job. So I talked a little bit about the U.S. economy. This is what we put in terms of a summary. Yes, the economy performed so far this year very strong, but recession risk remains. And our view is there will be a recession. You can expect the Fed to raise interest rate 5%, soon to be 5.25% by tomorrow, that the economy won't slow down. Things are slowing down, but to a level that the Fed wants, we're not there yet. So likely there will be a recession sometime. We don't know if it's going to be next year because the economic data has been strong. But if we have a recession next year, it's barring any catastrophic events, it's likely to be a mild recession because of the slowdown in lending, because of the higher rates that we have that translate, or the lagging economic data that haven't shown up in the economy. The housing market, so earlier in the year and late last year, housing prices started to come down, and back in March with regional bank issues, housing prices seem to have experienced a shock that it could drop further, but since then it's actually had gone back up. So since March of this year until now, average home prices actually gone up. If you look at just the interest rate on mortgage rate, 2 years ago it was under 3% for 30-year fix, or right around 3% for 30-year fix. If you go out and get a mortgage today, it's close to 7%, over 7%. And so why does that not translate into housing prices? It should have dropped because, 2 years ago, with the same amount of monthly income, you can afford certain prices. Now, mortgage rate gone up, over 4%. Your payment would have gone up about 30, 40% for the same house. Why, and your income definitely didn't go up that much. Why didn't housing prices go down? Well, we still have a housing shortage. There's a lot of homeowners who had their mortgage rate at 3%, 3.5%. In a normal market condition, those are the ones who would sell and move into other areas, or, as a lot of workers retire, they downsize from their bigger house into a smaller house. For a lot of these people, if you're selling your house right now, where are you going to go? If you have to buy and add a new mortgage back into the house, you bring a 3% mortgage into a 7%. So there are not a lot of buyers out there. And in the structure of the economy, we have a group of millennials that are now in the age of buying houses that they are not looking, or they don't have enough supply to select from. And that contributed to a more tight housing market that prices kept going up. I talked a little bit about interest rates. So this is a summary from our last Federal Reserve meeting. At the last meeting, the Fed's paused interest rate hike, but they said that they would depend on data and expect to raise interest rate again later this year. So far, economic data, or the market is expected the Fed to raise interest rate at this meeting another 0.25%. The Fed, on their dot plot that they project, that they expected to raise interest rate twice again this year. So likely tomorrow, and then one more time in the next, within the next 6 months. The market doesn't believe that right now. What the market is saying that the Fed likely will raise interest rate one time tomorrow, and that will be it for the remainder of the year. And that's more to do with the concern about the lagging economic indicator from interest rate hike that hasn't shown up, and which also, the slowdown in the economy that we see in the leading economic indicator. But, things could change, and our view is we follow the market, and we expect the interest rate to be, the Fed will raise interest rate at this meeting tomorrow, and then that's going to be it for this year. We don't believe they're going to think about cutting rates, but that's, of course, based on data that the Fed will decide. We talked about real estate a little bit, but commercial real estate, we don't, I'm not going to cover it. Just in terms of the U.S. stock, I talked a little bit about the S&P. S&P was up 17%, but on the value side of the market was only up 5%. And that shows, and you probably heard many times over the last few months, how concentrated the return had been for stock. It's the 7 largest companies in the S&P carry the entire S&P. So 7 companies on average for the first half of the year, the largest 7 companies in the S&P return about 45%, up 45% for the year. The rest of the S&P, take out those 7 companies, was up less than 5%. But if you include them all, average out, the S&P was up 17%. So that's, our view, this rally has been very concentrated in those mega large cap tech stock. Our view is the market doesn't have to be, the overall S&P doesn't have to go down significantly from here, but the market can trade sideways. Basically, the S&P from now to the end of the year can be flat, And it's still good for the overall market because we expect some broadening out of other sectors that hadn't performed. So tech stock can actually go down, but other part of the S&P and the index can continue to go up. Average out still, the S&P can stay flat, but the strength of the market or the health of the market can be improved from there. Let's skip this page. International equity, I'm not going to talk about it. We don't have any international stock in the portfolio. I talked a little bit about the return. Let's move to the next page. And we don't have any. So our firm view summary, global equities, we have a neutral view, meaning if you look at valuation right now on US stock, it's more on the expensive side. But if you strip out the largest companies, valuation is quite healthy. It's normal market condition. It's not cheap. Last year, around, in October, November, you could say valuation was quite cheap, and that could contribute to the better performance this year. Right now, it's not cheap, but it's not too expensive. Strip out the largest stocks in the S&P. If you include them, actually looking forward, it's quite expensive. And so it's going back to my view, my point a little bit earlier, that the S&P can trade sideways, not going anywhere. Tech stock can sell off. That the rest of the market can improve, and that could help the health of the market. Fixed income and cash, right now, interest rate is higher. It's probably near the high of the cycle. So our view is, we want to maintain our allocation in fixed income. If rates continue to go up, we likely reduce equity and add more to fixed income. If you're just sitting in Treasury right now, you're earning a little over 5%. That's the target for the pension over the last few years. Over 4% was kind of on average. We have exceeded that, and it's just fixed income, not taking any equity risk. We can get close to that number or slightly above. This is where, for a pension account, adding more bonds at this time makes a lot more sense. And that's the conclusion of our last quarter review. Any questions, concerns?
I'm going to put you on the spot.
Yeah.
Do you know for our bond, the portion of our portfolio that's in bond, what the average time frame for those is?
So the average, on the short-term bond, the Vanguard short-term, is about two years. On the Dodge and Cox, it's much longer. It's about 5 to 6 years. When I say much longer, that's the most that we want to go, because right now, if you look at this year, the middle part of the bonds, rates come down since the beginning of the year, so it contributed to the better return. But if you look at just Treasury, the 6-month Treasury and 1-year Treasury gives you about 5.5% to 5.25%. You extend it out to 3 years or 4 years, that goes down to about 4%, 4.5%. And that's what you probably heard about the inverted yield curve. That's what's happening. Why do we stay on the middle or longer bonds? It's because we believe that when there's any signs of a recession or talk about the recession, the short-term interest rate will start dropping. The long middle part will stay there, and the long end will go down as well. But it's kind of flattened out the curve. So even though if you're staying at the middle part, 3 years to 5 years, it's not as attractive as staying in the very short 1 year to 2 year. At the moment, we still believe that rate for the middle part is at the high for this cycle. And that's the reason why we stay a little bit longer. So if you average out, the bond allocation is about 4.5 years.
All right,
Any other questions?
thank you.
All right, thank you very much.
Thank you.
I will be back next quarter. I guess we won't see you, Heather. All right. Thank you.
Thank you. Do we take public comment on presentations? Do we have public comment? No. Okay, moving on. 6.1, the updated pension calculations for November 2023. So for this one, the disability pension recipients receive benefits that match the MOUs. And the police MOU has a memorandum of understanding or union agreement, has its last COLA for the agreement in November. Now, there is another meeting between now and then. However, since I am going to be leaving, I brought this now so that it is all in and approved so that nobody has to worry about it and everyone gets their increase in November with no issues. So the fire MOU, they had their increase in July, so that was brought with all the calculations for the just regular service retirees. The disability fire payments were brought in in June for July with all of those. This one is specifically for police disability retirees. And all the calculations were included with the attachment. Are there any questions, or does someone want to make a motion?
I'll move the item.
I'll second.
Member Ford?
Aye.
Member Berry?
Yes.
Member Tiedemann?
Yes.
And I vote yes, and Chair Rowden.
Yes.
So the motion carries.
Thank you. So number 7 is future agenda items. Does anyone have anything that they would like to add to a future agenda? All right. The next meeting is October 24th at 3 p.m. And with that, we are adjourned.
Thanks.